We've all heard the phrase, renting is just throwing your money away. It's one of the most effective pieces of marketing in human history. It's designed to make you feel a sense of quiet panic every time you write a rent check. It frames the landlord as a winner and the renter as a victim. But when people say renting is throwing money away, they are usually comparing a monthly rent check to a monthly mortgage payment. They are looking at the headline, but they aren't reading the fine print. Here's what I want you to imagine. You're 28 years old. You've been disciplined. You've saved $85,000. You're making $75,000 a year at a job you like, but you're not sure it's where you'll be in 5 years. Your parents ask you at Thanksgiving, when are you going to stop throwing money away and buy a house? And suddenly, you feel behind. You feel like you're failing at adulthood. Today, I want to look at the fine print of that question. We're going to look at why a mortgage isn't just saving, but a complex series of unrecoverable costs. We're going to look at the mobility premium of renting. We're going to examine the math of opportunity cost. And we're going to talk about the psychological machinery that pushes people into the biggest purchase of their lives before they're actually ready. If you're feeling pressured to buy because it's just what adults do, I want you to take a breath. Buying a house is the largest financial decision of your life. It shouldn't be made because of a catchphrase or family pressure. Let's look at the mechanics.
Pillar 1. The phantom costs of ownership. Let's start with a fundamental truth that most gurus ignore. Rent is the maximum you will pay for housing this month. A mortgage is the minimum. When you own a home, the monthly payment you see on the bank's website is just the beginning of the story. There are 3 gears that turn in the background, quietly eating away at your equity. The interest gear. In the first 10 years of a 30-year mortgage, the vast majority of your payment isn't going to the house, it's going to the bank. Let's look at the actual numbers. Say you buy a $400,000 house with a 20% down payment. You borrow $320,000 at 7% interest. Your monthly payment is about $2,128. In month 1, here's how that breaks down. $1,867 goes to interest. $261 goes to principal. That means 88% of your payment is thrown away just like rent. You're not building equity. You're paying the bank for the privilege of borrowing their money. Even by year 5, you're still throwing away about 80% of every payment to interest. It's not until around year 18 that more than half of your payment actually goes toward owning the house. This is the part the real estate agent doesn't put on the glossy brochure. The tax and insurance gear. Property taxes and homeowners insurance don't build equity. They are pure overhead. And unlike rent, these costs almost always go up, not down. On that same $400,000 house, property taxes might be $4,800 a year or $400 a month. Homeowners insurance might be $1,500 a year or $125 a month. That's $525 every month that you will never see again. It doesn't go to the bank, it doesn't go to equity, it just evaporates into the system. And here's the kicker. These costs are tied to the assessed value of your home. If your property value goes up, your taxes go up. If insurance claims in your area increase, your premiums go up. You have no control over this. The maintenance gear. A house is a physical object being degraded by the sun, the wind, and the rain. On average, you should expect to spend 1% of the home's value each year just to keep it from falling apart. On a $400,000 house, that's $4,000 a year, or $333 a month that you throw away on a new roof every 20 years, $15,000, a new HVAC system every 15 years, $8,000, water heater replacement, $1,500, exterior paint every 7 years, $6,000, appliances, plumbing, electrical repairs. And this is the average. Some years you pay nothing. Other years, the foundation cracks and you pay $20,000. When you rent, your landlord absorbs this volatility. When you own, you are the landlord. And the house doesn't care if you just had an unexpected medical bill. The total picture. Let's add up the phantom costs for our $400,000 house in year 1. Interest, $1,867 a month. Property taxes, $400 a month. Insurance, $125 a month. Maintenance, $333 a month. Total unrecoverable cost, $2,725 a month. And you're only building $261 a month in equity. When you add these phantom costs together, you realize that homeowners also throw away a lot of money. They just do it in different buckets with different labels.
Pillar 2, the 5% rule. So how do we compare the two fairly? I like to use what I call the 5% rule. It's a way to calculate the unrecoverable cost of owning a home and compare it to rent. Here's how it works. Take the value of a house and multiply it by 5%, then divide by 12. That gives you the monthly break-even rent. $500,000 house times 5% equals $25,000 per year. $25,000 divided by 12 equals $2,083 a month. This 5% breaks down roughly like this: 1% for maintenance, 1% for property taxes, 3% for the cost of capital. Now, let me explain that 3% number because it's the least obvious. The cost of capital. When you buy a house, you're locking up hundreds of thousands of dollars. Even if you paid cash, that money is no longer liquid. It's not in the stock market, earning 8 to 10% historically. It's not in a high-yield savings account, earning 4 to 5%. That money has an opportunity cost. The 3% represents a conservative estimate of what you're giving up by having your wealth trapped in brick and mortar instead of working for you in other investments. If you take out a mortgage, that 3% also roughly covers the average interest cost over the life of the loan, especially in the early years when interest dominates your payment. Using the rule. Let's apply this to a real scenario. You're looking at two options in the same neighborhood. Option A, rent a 3-bedroom house for $1,900 a month. Option B, buy a similar 3-bedroom house for $475,000. Run the 5% rule. $475,000 times 5% equals $23,750 per year. $23,750 divided by 12 equals $2,083 a month. This 5% breaks down roughly like this. The break-even rent is $1,979. You can rent for $1,900. This means renting is financially cheaper. You are throwing away $1,900 per month. The homeowner is throwing away $1,979, and that's before any major repairs. The math is telling you to rent. When buying wins on the 5% rule. Now let's reverse it. Same $475,000 house, but rent in that neighborhood is $2,800 a month. The 5% rule says the break-even is $1,979. You're paying $2,800 to rent. In this case, buying is financially cheaper. You'd be throwing away $821 more per month by renting. This is when the math says, buy if you're staying long enough. Why this rule matters. The 5% rule removes the emotion. It removes the social pressure. It removes the real estate agent's charisma. It gives you a number, a break-even point, a threshold. If rent is below that threshold, rent and invest the difference. If rent is above that threshold, and you're staying for 7+ years, buying might make sense. Don't listen to the catchphrases. Look at the 5% rule. It leaves only the logic. Now let's talk about the big check, the down payment. When you buy a house, you might put down $50,000, $80,000, or $100,000. Most people see this as investing or putting money into an asset. But I want you to think about opportunity cost. That $100,000 is now dead capital. It is locked in the walls of your house. It is no longer working for you. The 10-year comparison. Let's run a thought experiment. You have $100,000 saved. Two paths. Path A, buy a house. Put $100,000 down on a $500,000 house. House appreciates at 3.5% per year, historical average for U.S. real estate.
After 10 years, the house is worth $710,000. You've paid down about $60,000 in principal. Your equity position is $310,000, down payment plus appreciation plus principal paydown. Sounds great, right? But wait, you also paid around $180,000 in interest over 10 years, around $48,000 in property taxes, around $15,000 in insurance, and around $40,000 in maintenance. Your unrecoverable costs are $283,000. Path B, rent and invest. Rent for $2,000 per month or $240,000 over 10 years. Invest $100,000 in a diversified index fund earning 8% per year. After 10 years, $215,890. But you also saved money every month. If the 5% rule said your break-even rent was $2,400 and you only paid $2,000, you saved $400 per month. Invested at 8%, that's another $73,600 over 10 years. Total liquid wealth is $289,490. You threw away $240,000 in rent, but you have nearly $290,000 in investable assets. The homeowner threw away $283,000 and has $310,000 in equity, but it's trapped in a house. They can't spend it without selling and paying 6% to an agent, which is $42,600. After selling costs, the homeowner nets $267,400. The renter wins. The variables that change this, of course, depend on how much the house appreciates. 3.5% is average, but varies wildly by market. How much the stock market returns. 8% is historical, but not guaranteed. How much you actually save by renting cheaper. Whether you would actually invest the difference, which most people don't. But the point is this: a house is not automatically a better investment than a diversified portfolio. In fact, historically, it's often worse. Real estate in the U.S. has appreciated at about 3 to 4% annually over the long term. The S&P 500 has returned about 10% annually. Even after accounting for volatility and risk, stocks have outperformed housing as a pure investment. The liquidity problem. There's another cost that doesn't show up on spreadsheets: liquidity. If you need $20,000 for an emergency and your wealth is in stocks, you can sell shares in 3 days. If your wealth is in your house, you have 3 options. Take out a home equity loan, now you're paying interest. Sell the house, 6 months, 6% agent fee, closing costs, moving expenses. Or don't access the money. Your home equity is frozen capital. It's an illiquid asset masquerading as wealth. If you're buying a house purely as an investment, you're often choosing a lower performing, higher maintenance, less liquid asset than the stock market. Pillar 4. The mobility premium. There is a cost to buying a house that isn't found on a spreadsheet. It's the cost of immobility. And if you are in your 20s or 30s, this might be the most expensive cost of all. Your greatest asset. Your greatest financial asset isn't a house. It's not even your savings account. It's your earnings potential. The difference between earning $60,000 a year and $90,000 a year over a 30-year career is $900,000. The difference between earning $90,000 and $120,000 is another $900,000. Early in your career, your ability to increase your income is worth more than any investment you can make, and that ability requires mobility. The renter's advantage. If you rent and a company in another city offers you a $20,000 raise, you can move in 30 days. You give notice, you pack, you go. If you own a house, moving is a 6-month ordeal. List the house, 1 to 2 weeks. Wait for offers, 2 to 8 weeks, depending on market. Close the sale, 4 to 6 weeks. Pay the real estate agent 6%, $30,000 on a $500,000 house. Pay closing costs, another $3,000 to $5,000. Move and settle in your new city. By the time you've done all this, the job opportunity might be gone, or you might have lost $35,000 in transaction costs. If you haven't lived in the house for at least 5 to 7 years, those selling costs will likely wipe out every bit of equity you built. The break-even timeline. Here's the brutal math. On a $500,000 house, agent commission, 6%, closing costs, on the seller side, $5,000, moving expenses, $3,000, repairs and staging to sell, $5,000. Total cost to sell, $43,000. In the first few years of ownership, you're barely building equity because most of your payment goes to interest. Let's say you build $15,000 in equity over 3 years. If you sell after 3 years, you're $28,000 in the hole compared to if you had just rented. The general rule, you need to stay in a house for 5 to 7 years just to break even on transaction costs. If there's any chance you'll move before then, new job, relationship change, family needs, buying is a financial gamble. The career multiplier. Let's make this concrete. You're 29. You rent an apartment for $1,800 a month. A recruiter calls. There's a job in another city that pays $25,000 more per year. If you rent, you take the job. Over the next 10 years, that extra $25,000 per year, compounded with raises, becomes $300,000 plus in additional lifetime earnings. If you own, you have to sell. 6 months later, after paying $40,000 in selling costs, you move. You've lost time, money, and possibly the opportunity. Renting isn't throwing money away. It's paying for optionality, and in a dynamic economy, optionality can be worth hundreds of thousands of dollars. When stability wins. Now, I know this calculation changes as you get older. If you're 45, married, with kids in school, and you've been at the same company for a decade, your immobility premium is much lower. You're not chasing the next opportunity, you're building stability. In that case, the immobility of home ownership isn't a cost, it's a feature. It forces you to put down roots. But if you're young, single, or early in your career, mobility is currency. Don't trade it for a house unless you're certain you want to stay.
Pillar 5. The psychological machinery. Let's talk about the invisible forces that push people into buying before they're ready. Because this isn't just about math, it's about the stories we've been told. The home ownership myth. There's a narrative in American culture that goes like this. You're not a real adult until you own a home. Renting is for college kids and people who can't get their life together. Home ownership is the foundation of wealth. This narrative was manufactured. After World War II, the U.S. government subsidized home ownership as a way to stabilize the economy and create a middle class. The 30-year mortgage was invented. The mortgage interest deduction was created. Fannie Mae and Freddie Mac were born. It worked. Home ownership rates soared, and an entire industry, real estate agents, mortgage brokers, home builders, grew around it. But here's what happened. A policy tool became a cultural religion. Owning a home went from a good financial move for stable families to the only acceptable path to adulthood. And now, people buy houses not because the math works, but because they feel like they're supposed to. The forced savings myth. One argument you'll hear is, a mortgage is forced savings. If you rent, you'll just spend the money. And look, there's some truth to this. If you are the kind of person who will spend every penny in your checking account, then yes, a mortgage acts as a behavioral guardrail. It forces you to build equity whether you want to or not. But let's be clear, this is not an efficient way to save. You're paying 6–7% interest to the bank in order to force yourself to save. You're locking up your capital in an illiquid asset. You're taking on massive transaction costs. If you need forced savings, there are better tools. Auto transfer to a high-yield savings account, automatic investment into index funds, employer 401k with auto escalation. These give you the same behavioral benefit without paying the bank $200,000 in interest over 30 years. The forced savings argument is an admission that the buyer doesn't trust themselves. And if that's true,
Maybe they're not ready for the responsibility of a $500,000 asset that requires $40,000 in maintenance over the next decade. Social pressure and FOMO. Here's the final piece of the psychological machinery: fear of missing out. Your friends are buying houses. Your coworkers are buying houses. You see Instagram posts of people holding keys in front of their new front door. And you think, am I falling behind? Housing markets feed on this fear. When prices go up, people panic buy because they think they'll be priced out forever. When interest rates are low, people rush in because it's the perfect time. But the reality is there is no perfect time. Interest rates go up and down. Housing prices go up and down. If you wait for the stars to align, you'll wait forever. The question is not, is now the perfect time? The question is, does buying a house fit my current system? Do you have stable income? Do you want to stay in this city for 7+ years? Does the 5% rule say buying is cheaper than renting? Do you have an emergency fund that can handle a $10,000 roof repair? If the answer to all of those is yes, then buy. If the answer to any of those is no, then wait. The houses will still be there. The lifestyle inflation trap. One last thing. When people buy a house, they don't just buy a house, they buy a lifestyle. They buy a bigger house than they need because we might have kids someday. They buy in a more expensive neighborhood because it's a better investment. They buy new furniture because the old stuff doesn't fit the space. Within 6 months, they've increased their cost of living by $1,500 a month, and now they're trapped. They can't take a lower-paying job they'd love. They can't quit and travel for a year. They can't take a risk on a startup. The house owns them. Renting keeps your cost of living flexible. It lets you make career and life decisions without checking with the mortgage first.
Pillar 6. When the math says buy. I am not against homeownership. I believe in it, when the system is ready. Let me tell you when buying makes sense. Condition 1. The 7-year rule. You are 95% certain you will be in that city, in that house, for at least 7 years. Not pretty sure, not probably, certain. Because if you sell before then, the transaction costs will eat your equity and you'll wish you had rented. Condition 2, the 5% rule says buy. Run the numbers. If the 5% rule tells you that renting costs more than the unrecoverable costs of ownership and the gap is significant, buying starts to make financial sense. But you have to be honest about the numbers. Don't fudge the property tax estimate. Don't assume the roof will last forever. Use real data. Condition 3, you have a full emergency fund. You should have 6 months of expenses saved in addition to your down payment. Because once you own a house, emergencies don't stop. The water heater doesn't care that you just spent your savings on a down payment. If buying a house wipes out your liquidity, you're not ready. Condition 4, the emotional dividend is worth it. Some people want to own a home not because of the financials, but because of the freedom. They want to paint the walls. They want to knock down a wall and build an open kitchen. They want to plant a garden and know it will still be there in 5 years. That emotional dividend is real, and if it's worth the phantom costs to you, that's a valid reason to buy. But notice, it's not a financial reason. It's a lifestyle reason, and that's okay. Just be clear about what you're buying. Condition 5, you're building stability, not chasing returns. If you're at a stage in life where you want roots, where you want your kids to grow up in the same house, where you want to be part of a community for decades, then buying makes sense. But if you're buying because you think it's a great investment, run the numbers. Compare it to index funds. Factor in the opportunity cost. Most of the time, real estate underperforms the stock market.
Conclusion: the calm decision. If you choose to rent for the next 5 years, you aren't falling behind. You are staying liquid. You are staying mobile. You are avoiding the minimum payment trap of a mortgage. You are keeping your options open in a world that rewards flexibility. And if you choose to buy, do it because The 5% rule says it's cheaper than renting. You're certain you'll stay for 7+ years. You have an emergency fund. You want a home, not just an asset. There is no right answer. There is only the answer that fits your current system. Ignore the pressure. Ignore the catchphrases. Ignore the fear that you are falling behind. Take your time. Run the numbers. Make the decision that serves your life, not someone else's idea of what your life should look like. The houses aren't going anywhere. I'm Ben. Let's just keep looking at the math.